Hello everyone, and welcome back to the Mortgage Rundown. Today we're going to talk about the growth story. Since the election, there's been a sense of hope that growth in the United States will accelerate from the very lackluster pace over the last several years. The stock market certainly has accepted this narrative, and stock indices have climbed between 7 and 10% since January 1st. The tech-heavy NASDAQ index is up 15%. But there are cracks in this growth story that's driving the stock market higher. Did you know that 1/3 of stock market gains are from 5 companies? Or that the price of oil and other commodities have been dropping? What about the probability of any meaningful healthcare reform or tax reform in the foreseeable future? Add to all that, interest rates are down 25 basis points since January 1st. If this pro-growth story is so certain, why are interest rates coming down instead of going up, especially with the Fed expected to raise rates in June? Take a look at the graph on your screen. It compares the probability of a June rate hike versus the 10-year Treasury. Generally, they should move in the same direction, but as you can see, the probability of a June rate hike is increasing, yet the yield on the 10-year is dropping. That leaves us with this big divide. Long-term interest rates are coming down versus stock prices and short-term interest rates are continuing to climb. Now, in the middle of those two is the Fed and inflation. Inflation is the barometer of growth essentially, and the Fed is likely going to move interest rates with inflation. However, this week we saw that core PCE year over year was only 1.5%, still well below the Fed's 2% target, and yet the market continues to price in a 90% chance of a Fed raise in June. The market is telling two very different stories. Is the market wrong? Is the Fed overconfident in the economy? Is the pro-growth story overshadowing economic reality? All these questions will be answered in the next few months. In the coming weeks, you should keep an eye on the following items. Number 1, Friday's non-farm payrolls and employment data. 2, inflation data to be released the week after next. And 3, short-term and long-term interest rate spreads. But most of all, please keep an eye on headlines. Market volatility is down, so headlines are likely to move rates. If you'd like a more in-depth analysis, please visit our blog. You can find it below or click this button here. Thanks for watching and have a great day.